Hello to everyone on the webinar. I'm Dwayne Dippenaar, and I'm here to update you on the SA Equity Fund's performance for the first quarter of 2024. If we just stand back and look at what happened in the market in the first quarter, you can see the Nedgroup SA Equity Fund down 2.5%, basically in line with its index, the Cap Swix. But domestic SA equity is under a lot of pressure, down over 6% for the first quarter. On the other side of things, the dual-listed stocks in the JSE doing relatively well, up 5%, and the Resi stocks basically flat year-to-date. Thus being said, after the quarter, we did have a very strong rally across platinum stocks, diversifieds, and gold stocks. The Rand continued to weaken slightly, 3% year-to-date, and that really helped the MSCI Emerging Markets Index performance, obviously 3% of that performance coming from the weaker Rand. And then in the States, the S&P 500 continued to power forward, up 15% in the first quarter of the year. This is just a graphical representation of the fund's performance since inception. The fund's now turned 10 years old, and you can see since inception, the fund has both outperformed its peers and its index. If we then break down that performance over various periods, you can see, as mentioned, year to date, the fund performing in line with its index. But unfortunately, the fund has had weak performance over a 1-year period, and you can see that really playing into the 3-year and 5-year performance numbers. Thus being said, from inception, the fund's still performing very strongly, nicely ahead of its index after all fees. What I find more interesting is the rolling 5-year performance of the fund. As you can see at the bottom of the chart, 75% of the time it's outperformed its category peers, and 82% of the time over any 5-year rolling period, it's outperformed its benchmark. We then just stand back and look at how the fund performed against its index in the first quarter. You can see our preferred gold stock, Anglo Gold, performing very nicely, adding to the fund. But unfortunately, the 2 gold stocks we didn't own, Harmony and Goldfields, costing the fund. Standard Bank, we've sold down a large portion of our Standard Bank position on the fact that we think the African earnings in the mix of Standard Bank's earnings are going to come back, and we've seen that stock under pressure because of that. We also didn't own any Remgro, which came under pressure because of disappointing results, and we've had a long-standing large position in British American Tobacco, which started coming through this year and was a positive contributor to the fund. On the negative side, our preferred bank, ABSA, was under pressure in the beginning of the year, but we still continue to hold high conviction in the stock and hold large positions there. We also have a large position in Sasol, which cost us, but subsequent to the oil price rallying, Sasol has started to have quite a strong run post-quarter end. We just then stand back and look at the market and what we think is going to happen for the rest of the year in the SA market. First and foremost, load shedding. At the beginning of last year, we spoke to you and said that we think load shedding could come to an end at the end of 2024. We've already seen a large improvement in the load shedding situation in South Africa. You can see here, this is the cumulative terawatt hours load shed year by year. And you can see in previous years, it was very low and then really started shooting up midway through 2022. And then 2023, you can see we had unprecedentedly high levels of load shedding, and that's the top green line. This year, 2024, you can see load shedding is definitely improved. Still not as good as we've seen it in the past, but a marked improvement. And now in the month of April, we've seen multiple days with no load shedding whatsoever, and we think it continues to improve. This is now just a graphical representation of the terawatt hours load shed per month, and you can see sort of that peak load shedding period we saw, the maximum negativity was really in midway through 2022 into 2023, and it's continued to improve month by month. And we now know that the month of April has been a very good month from a load shedding perspective. If we then say why we think that load shedding is improving, one of the main reasons is that the government deregulated the energy sector, and we see increasing private registrations of power, really renewable power, with NERSA. And you can see that really started picking up in 2022 with 1.6 gigawatts registered and 4.5 gigawatts registered through 2023. And that trend has continued into 2024 with 0.6 gigawatts being registered so far this year. All in all, that's close to 6 gigawatts that have been registered from private production, and that could equate to about 2 stages of load shedding. And we think that trend continues. And that really sort of dampens the demand from industry and households in South Africa and helps Eskom really get on top of their planned maintenance. And we have seen a pickup in planned maintenance. And so we also think Eskom production should improve to the back end of this year. And that should be a really great outlook from load shedding post 2024. And just to remind you, for every stage of load shedding, you can add 30 basis points of GDP growth to South Africa. So we really think this could be positive and a positive catalyst for GDP growth going forward. The other big bottleneck in the economy right now is Transnet. And we know it's really struggled to get volumes to the ports. And you can see Yaz Transnet volumes over time, and you can see how it's really dipped down in 2023. It does seem that the volumes have now stabilized. But just to put it in perspective, Durban Port right now ranks 365th out of 370 ports worldwide. So really rock bottom. So we think the base is extremely low. And with a few interventions, we can really see a great improvement in Transnet and its productivity. That port alone accounts for 46% of South Africa's container traffic. So by just fixing that, you can really have a big uplift on the container exports out of South Africa. And we know there's a private partnership being finalized right now, and hopefully that's finalized the back end this year, and that should really help the performance of that port. We also know that bulk corridors are about 12% of the actual rail kilometers, but account for about 61% of the freight potential in South Africa. So that would really be the coal and iron ore railways in South Africa. And we know that the private sector is really getting involved there. So any improvement there could really help ramp these volumes up pretty quickly. We've also seen action from Transnet. They're busy splitting the physical rail into an infrastructure manager, and that will really create a great environment for private competition on the rail network. Transnet is thus projecting quite a quick recovery in the actual volumes on the network. And we think this is a 3 to 5 year story. But as those volumes increase, you could really see a nice pickup in the amount of exports, especially coal and iron ore. And that will really be a great boost to the South African GDP numbers again. And once again, between Eskom and Transnet, we think you should see an improving GDP growth outlook for South Africa. The other big what if that people are worried about is the election results. We know the elections are now coming up at the end of May. First and foremost, if we stand back and look at this chart, the top yellow line is the ANC's vote that it's got in multiple national elections. And firstly, we can say that at least democracy works in South Africa. So if a party that's governing doesn't deliver services, you can see that over time it loses vote and support. And then we would see that as a big positive. We then look at where we think we will end up in the upcoming election. Firstly, we think the ANC vote will decline from the 58% that you've seen to about 46%, as you can see in the chart. And those are where the average of the polls that have done so far are pointing. Just keep in mind that generally for any one poll, there's about a 6% margin of error either way. And if you were to average out all the polls, there's about a 3% margin of error. What has happened recently, since most of the polls have been done, is that the MK party, people have started estimating what the MK party's vote could be, especially in KZN. And there are estimates that the MK party could get up to 8% of the vote. And in that case, the ANC could drop down to 42%. Our base case would still be then that there's a DA-ANC coalition. We believe that's where everything is pointing. And the odds of an EFF-ANC coalition, which would be on the downside, are pretty low at this point. And the ANC-DA coalition, we think we could be very positive and really get international investors interested in our market again. If we then look at the ANC's election or forecast election results by province, you can see in Gauteng, KZN, and the Western Cape, they will not have control of the various provinces. So the Western Cape, we already know the DA does have control of the Western Cape, but ANC projected to lose both Gauteng and KZN. This could point to coalition politics in those various provinces. And while we have seen a lot of negative news around coalitions, we do know that coalitions can work very well in many democracies around the world, Germany being one. And we've also seen the Good Governance African Government Performance Index, where they looked at the 20 best performing municipalities in South Africa, and 4 of those were governed through coalition agreements. So it points to the fact that coalition agreements can work if well implemented. If we just then look at the GDP per province, we can see between Gauteng, KZN, and the Western Cape, 63% of South Africa's GDP is produced out of those provinces. So we could see a new government or governing alliance in those 3 provinces that are really some of the big drivers for South African GDP going forward, which we think could also be a positive catalyst. If we then overlay South Africa's valuation on top of these positive catalysts that we see, firstly, this is the forward PE of various MSCI indices. You can see the South African index in yellow used to trade in line with developed markets and emerging markets peers, and has really derated quite rapidly since the days of Zuma being president. Right now, you can see there's been a re-rating in multiple markets around the world, the S&P, the MSCI World, but really no re-rating whatsoever in the MSCI South Africa, which is on a relative basis, we think, trading very cheap. If we then delve deeper into the valuation and look at the valuation of domestic South African stocks, we think that there's a lot of opportunity here, and they are trading very cheap, over 1 times standard deviation cheap from where they traded in the past. We acknowledge that interest rates are higher, and thus the forward PE rating on those stocks should be lower, but where we're trading now close to a 9 forward PE rating, we think the local market or domestic focused stocks present a really interesting opportunity for our investors. If we then look at how we've positioned the portfolio to take advantage of the opportunities we see in the local market, firstly, we still got large positions in Naspers Prosus trading at a high 30% discount to its underlying intrinsic NAV, and Tencent trading on about a 12 forward P if you take off its associate portfolio, with very strong earnings growth forecasts going forward. We still think this is a very, very attractive investment opportunity. We still have a large position in British American Tobacco, which we think from a valuation perspective has priced in all the negativity around the American market, and it also has a strong dividend underpin on a 10% sterling yield. We've established large positions in Richemont and AB InBev, so both dual-listed stocks, which we think from a valuation perspective look attractive. They have had a strong run in the beginning of the year, and we did take advantage of that to cut our positions and take a bit of profit. In the South African financial space, we still think the banks look extremely attractive. A bank like Absa trading below a 6 forward PE on a 9% dividend yield, and FirstRand, which is a high-quality bank coming back now and presenting a great opportunity on about an 8 forward PE. In the SA Inc. space, or companies that are really focused to the domestic economy, we've seen a lot of pressure on many of those stocks, and we've taken advantage of that to establish positions in industrials like Bidvest and Motus, where we think the market is pricing in a lot of negativity, and we see earnings forecasts growing forward quite strongly. In the resource space, we've still got decent exposure to the diversified miners, Anglo American being our preferred. In the paper and packaging space, we had positions of both Mondi and Sappi. We sold down our Sappi position completely on strength, and we still hold a decent exposure to Mondi, which we think looks attractive on a valuation perspective. And then our preferred gold plays, Anglo Gold, where on a relative gold valuation, we think it looks more attractive than the likes of Gold Fields. From a portfolio positioning perspective, you can see a large part of the portfolio is still exposed to the global consumer. That would really be Prosus and Naspers, British American Tobacco, AB InBev and Richemont, and we've also established a position in Bidcorp. Still decent exposure to the South African banks, where we're seeing a lot of value and still good earnings forecast growth going forward. Still exposure to the diversified mining space. And one other area to maybe mention is decent exposure to the PGMs, where we're still constructive as global forecast for electric vehicle sales has dropped off, which is positive for catalytic converters going forward and the PGMs. And we have started to see the PGMs rally post the quarter end. From a geographic perspective, you can see 32% of the fund exposed to developed markets, 31% of the fund exposed to the domestic SA market, and we have started to increase that percentage as we've seen opportunities, but still below a benchmark weight. And then emerging market exposure at 20%, really driven by large exposure to Naspers Process, which has exposure to Tencent in China. One other area to mention is maybe the SA USD exposure at 9%, and that would really be driven by companies that are based in South Africa, but that are really dollar earners, such as the PGM stocks. We just look at what we've traded in the first quarter of the year. As I mentioned, we've established a position in Bidcorp. The stock was under a bit of pressure, and we thought the valuation looked very attractive for a global consumer stock. We've also started buying some South African industrials like Bidvest. We topped up a position in Naspers Process on weakness, and the same for Absa and Richemont. We also took advantage of weakness at the beginning of the year, and subsequently to a very strong rally, have started trimming that position post-quarter end. On the selling side, we sold some AB InBev after quite a strong run on decent results. We sold completely out of our Sappi position, and that's also on strength, and we think Sappi is now starting to look fully valued. We sold down some of our MTN position, and that's based on the risks around the Naira. MTN has come under a lot of pressure recently and is starting to look more attractive. We also took advantage after doing a lot of work and meeting with management team, the current management team of Pick n Pay and the past management team of Pick n Pay, as well as the chairman of the board, to sell down our position in Pick n Pay completely. Subsequently, the company has announced a rights issue and the stock has come under a lot of pressure. And we sold down a bit of our Mondi position on strength. If we look at the top 10 positions in the fund, you can see the fund's still relatively highly concentrated, with 62% of the fund in the top 10 positions, but we still think nicely diversified from a geographic and sector perspective, and we believe very well positioned to generate good returns for our clients going forward.